Good evening. My name is Dr. Byron Liu, and I am the chair of the Department of Economics here at Trent. As we gather this evening, we respectfully acknowledge that we are on the treaty and traditional territory of the Mississauga Anishinaabe. We offer our gratitude to the First Nations for their care for and teachings about our earth and our relations. May we honor those teachings. On behalf of Trent University, it is my honor to welcome you to this year's Harry Kitchen Lecture in Public Policy. This lecture honors one of the university's founding professors, Harry Kitchen, and his research contributions to public policy in municipal finance and governance. At Trent, we strive to be a strong partner, enhancing the community and culture of both Peterborough and Durham, sharing knowledge through our series of community speakers, all made possible by the generous philanthropy of donors, is just one of the ways we give back to the communities. I'd like to take a moment to recognize Professor Harry Kitchen. Professor Kitchen is an internationally respected economist whose research focuses on municipal economics and policy. He consults widely, both domestically and internationally. Among his many honors, Professor Kitchen was awarded the Queen's Diamond Jubilee Medal for contributions to research on municipal finance and governance. This lecture series was established upon his retirement by colleagues and friends to continue Professor Kitchen's dedication to disseminate practical policy goals. The objective of this annual lecture is to provide access to experts and thought leaders to Trent University and the wider community. On behalf of Trent University, thank you, Professor Kitchen, for your esteemed career and generosity in many ways to Trent. Before I introduce tonight's guest speaker, I want to offer a quick overview of how the evening will run. Throughout the evening, we encourage you to engage in the talk. Please feel free to use the chat feature to share your thoughts, to connect, and to network. Following the lecture, we will move to a Q&A session, which will be moderated by Dr. Shutao Kao, a faculty member of the economics department here at Trent. Should you wish to ask a question during this portion of the evening, please submit your questions into the Q&A feature, which is located at the bottom of your screen. We will do our best to get to as many questions as we can. This evening's lecture is being recorded and will be available for viewing on the Harry Kitchen Lecture webpage next week. Now, for today's lecture, it is my great pleasure to introduce our guest speaker, Carolyn Wilkins, with her topic tonight, Exploring the Crypto Frontier. Bitcoin, stablecoins, NFTs often enjoy top billing in daily news feeds, particularly in recent weeks. Carolyn will demystify this crypto frontier and the emerging decentralized finance ecosystem that crypto assets like Bitcoin and Ether enable. She'll talk about the origins and main features of the near $2 trillion crypto asset market, what benefits it might hope to deliver to households and businesses, and the urgency of developing sensible legal and regulatory frameworks to address the growing threats to investors, market integrity, and financial stability for these benefits to be realized. It is my pleasure to introduce Carolyn Wilkins, the 2022 Harry Kitchen guest speaker. Ms. Wilkins is a senior research scholar at Princeton University's Griswold Center for Economic Policy and is on the board of directors at Intact Financial Corporation. She is a mentor for the blockchain stream at the Rotman School of Management's Creative Destruction Lab. But prior to these appointments, Ms. Wilkins had a distinguished 20-year career at the Bank of Canada, serving as the senior deputy governor, setting monetary and financial system policies with the governing council, and overseeing strategic planning and economic research. She led the development of the bank's market liquidity facilities and large-scale asset purchase program as part of its COVID-19 response. She has made important contributions to international financial policies over her career, most recently at the Bank of Canada's G20 and G7 deputy and member of the Financial Stability Board. Ms. Wilkins has published and spoken on a broad range of international issues, including economic resilience, global financial regulation, and fintech. And now I want to welcome Carolyn Wilkins.
Thank you very much, Byron, for that great introduction. And also, I'd like to just thank you for the invitation to participate in this Harry Kitchen lecture in public policy. I just can't think of a better subject given the public policy issues that crypto assets and the emerging financial ecosystem that they enable present to regulators and lawmakers and authorities in general, not only in Canada, but around the world. It means a lot to me as well from a personal point of view, because many of you may not know that I was born in Peterborough. I grew up in Selwyn, went to Lakefield High School, and I have very fond memories of Trent University. I studied for many high school exams in the Bata Library. You know, my first job was at the Selwyn General Store at a time when cash was still king, and something like Bitcoin would have been the stuff of science fiction. And so I do hope to demystify some of this for you tonight. And I'm really looking forward, in particular, to the time when we can ask questions. So to do this, I thought that what I would do, here's a bit of a roadmap. I'm going to start with some context of the drivers of the fintech revolution and this blockchain technology. And then I'll go through some facts about crypto assets and decentralized finance, or DeFi, that you read about, and draw out where I think there is promise from these innovations and the principal issues for financial sector policy and regulators. And I'll also talk about where some investments are needed in terms of a legal and regulatory framework, as well as other things, to ensure that these innovations end up being in the public interest. So if we start with the drivers of the fintech revolution, the crypto universe is really happening in what I'd like to say is a broader wave of innovation that's affecting financial services, and people call it fintech. You just think about today how you can use Apple Pay to buy a coffee or manage your own portfolio use an investment app on your phone. And where this is coming from is really, I think, principally more demanding consumer in terms of the services that they're going to receive, the convenience of their financial services. And that's been paired with what we've observed, unfortunately, as an eroding trust in public and private institutions. I think when you look at some of the trust indicators, the one I like to look at is the Edelman Trust Barometer that covers in many countries. You just see how trust in all institutions took a hit following the global financial crisis in 2008, 2009. But the most recent data show that the pandemic has also put trust to the test yet again. Now, of course, these expectations need to be enabled by something, and that's technology. And I have to say, the door was wide open for competition, and competition that was enabled by technology because of the inefficiencies in the financial system that we have already. I mean, banks, just as an example, still in some cases still run on COBOL, if you even remember what that is. And at the same time, they enjoy some market power. So innovations in big data, mobile tech, combined with new business models, again, just think about tech firms getting into financial services, have really created a lot of change. And that's not necessarily a bad thing. Of course, it's also driven by some opportunities to get around the rules. There were a lot of new rules that came out of the global financial crisis, and some of this fintech, some of the crypto assets are a way to get around that. You know, I said that that technology was a big driver. And one of the technological innovations that is the foundation of the crypto world is called blockchain. And I think it's really important to look at that and say, well, what can that actually deliver? What is it? What can it deliver? Well, the first thing is pretty darn familiar. I mean, it's been around for centuries, and that's just record keeping on a ledger. What's different here is that permission to create records or to view the records is open in many crypto assets. So anybody can go in and do it if they want to. Whereas in traditional ledgers, as you well know, it's usually restricted to a trusted third party, like your accountant or yourself when you're balancing your checkbook. Now, these records are interesting because they're also time-stamped, they're organized in blocks that are linked together. And so you have a database that's enormous that is of every transaction that's ever made on that particular blockchain. And so, but a second, and I think probably more profound difference is that transactions that get on the blockchain by consensus among the participants rather than by a trusted third party who just decides. And the way that this happens is by a technical breakthrough that underpins the method for achieving this consensus. And the one that's used in Bitcoin is based on cryptography. It's the consensus mechanism. You may have heard of it. It's called proof of work. And I'm not a technician, so I can't explain exactly what it is, but the Cole's notes for it is really that it requires members in the network to solve a really hard mathematical problem that requires a lot of energy and effort. And they do this to validate the transactions and create new assets or mine new assets or tokens. And this is pretty important. One of the things, and I think it's important because it creates some efficiency gains that are huge, but it also creates a transparency about the data and a completeness in the data that is just so important to financial services given where they are today. Now, one of the things that blockchain advocates like to say, and this, in my view, is part of the hype, is that it kind of reduces the need for trust in a trusted third party. It cuts out the middleman, and this is pretty great. Well, it does cut out some of the middleman, but the reality is that this blockchain and the consensus mechanisms are not infallible. There's a number of things that can go wrong. One of them is called a 51% attack, and that's where miners or groups of people that are solving these mathematical problems can collude. They can come together and successfully cheat, so create fraud on the blockchain, make money from that. And in fact, it's not just a theoretical issue, it's actually happened. So several altcoins have failed due to these 51% attacks. And I've got them named here. I think the other thing that we also tend to miss here is that blockchain still requires trust. And I'll just give you one example. Think about the programmers. It's usually a narrower set of programmers that are in control of this, but those who are using services that are built on this blockchain actually need to know that the code is free from bugs, that it's resilient to tampering, and it does what it says on the label. Now, right now, these programmers have absolutely no responsibility. They have no accountability, and they certainly don't have fiduciary duty like similar types of people in the traditional system would have. And so I think this is an open question. I think another question is really about how expensive these consensus mechanisms are in terms of their energy use. I said it takes a lot of computing power to solve these mathematical problems, and there's some estimates that show that just for Bitcoin alone, to run that system uses the same amount of electricity as the Netherlands. And one needs to ask whether or not that's of social value. Now, the Bitcoin ecosystem, not the technology, the blockchain, but the ecosystem that's built on it also requires a whole lot of trust. You think, well, I'm a user of this and I want to buy something with it, say at Expedia. And like in theory, you could just go through the blockchain directly and do that. But most people find it too complicated to deal directly with the miners and with the system. And so what they do is they engage with user interfaces. So they want wallets or exchanges. They want financial intermediaries to store their Bitcoin and manage their keys and make transactions easier. The merchants actually who are taking this don't want to interact directly either. They don't actually really even want to hold the Bitcoins. And so they use payment gateways and other intermediaries to convert their Bitcoins received into sovereign currency, and sometimes immediately. And so I can continue on all the entities that you need to trust. But I think my point is made here that trust isn't obviated. It basically just shifts it around who you need to trust. And there's a number of examples how this trust isn't merited. I don't know whether you remember in 2018 when the CEO of Quadriga died. Well, Quadriga was Canada's largest crypto exchange, and at that time, when the CEO died, he was the only one that had the key to these cold storage wallets, the ones that are up here. I don't know whether you can see my cursor. Well, right now we've got up to $250 million. It's owed to over 100,000 customers. It's still missing. So if we turn to the crypto assets themselves, I put these lyrics up on the right-hand side because I just think it captures exactly the cultural impetus for growth in this market. There are a lot of financial reasons, but this is the culture one, and it's really back to that trust. This is just a riff off of a Drake song that I found is pretty popular among some people. But you could see how this sentiment has fueled what you can see on this chart as being explosive growth. And here what I'm showing you is trading volumes of crypto assets on a weekly basis. The blue line that's growing so quickly is all crypto assets together. For comparison, markets that we care a lot about, that people spend a lot of time thinking about when it comes to regulation or investment, like US corporate bonds on this brownish red line here, look really flat and a lot smaller by comparison. Municipal bonds as well. And I think that the interesting thing is not just the growth, but the fact that the growth is not fueled entirely by Bitcoin. In fact, Bitcoin, you can hardly see it. It's a gray line hidden there, where the line that stands out is actually the green one, which is stable coins. And I'm going to talk to you a little bit about what those are in a minute, but certainly this market is becoming pretty mainstream. Now, if you look at it from a different angle, market capitalization, on these terms, the crypto market has also exploded from just under, and this is in US dollars, 16 million 5 years ago, to hit nearly 3 trillion late last fall. And then right now it's about 2 trillion. That's a pretty astonishing growth rate. Now it's less than 1% of the entire global financial system, but it's still pretty impressive. Now, this market capitalization is made up of over 17,000 crypto assets, different crypto assets. It's not just Bitcoin, it's a bunch of them. What the square tries to do, or the rectangle tries to do, is basically show you the share of market capitalization of each of these main crypto assets. So you can see that Bitcoin has the largest of all of them, in terms of market capitalization, but Ether's there too, and there are many others that have a reasonable share and are actually growing. Now you can see that because of that, why when you read the newspaper, it's almost always going to be about Bitcoin or Ether. But I would say that the place to keep an eye on are these crypto assets down here in the corner. This is something that I took from the Bank of England, where I work as an external member of their financial policy committee. And I think they chose brown because they thought they were a little bit, I guess, safer, or yeah, that might be the reason. I don't know why they chose brown, but these are in a category called stable coins. And I will explain that in a minute again. But when you think about this whole universe of different kinds of crypto assets, the thing to know is that they each serve different purpose. They serve a different market. Some of them are very regional. And from a regulatory point of view, one of the biggest differentiators is whether or not they're backed or whether or not they're unbacked. And I'll talk to you right now about what that means. So if you have an unbacked crypto asset, what that means is that there's no intrinsic value and there's no other asset that's guaranteeing you a price or trying to hold the price steady. Now, about 90% or a little bit over 90% of the crypto market is unbacked. Bitcoin is a really good example of that. Now, because it's unbacked and it doesn't have a credible mechanism to stabilize its value, its price is highly volatile. And that means that it's really not useful as a store of value or a means of payment. In fact, it serves as a speculative asset, and it's at least a part, I think, of prevailing low interest rates and a search for yield. People are trying to find a way to make money on their investments. Now, since the bulk of these assets are vulnerable to major price corrections, we have to worry about investor protection. That at a minimum, people are informed of the risks. And this is particularly true given that exposure to these assets is widening to the retail investor. There's a recent survey that was out for the United States that showed around 15% of US households had engaged in crypto transactions last year. Now, backed crypto, on the other hand, is called stable coins. And what it does is it tries to achieve a stable value against fiat currency or other assets by maintaining reserves against backed assets. And I think that stable coins could yield important benefits in terms of real-time and competitive payment systems, both domestic and cross-border payment systems, if they're properly safeguarded. I think the benefits are only going to be realized if the stable coins are safe. And there are legitimate concerns about the existing stable coins, some of them, about whether the assets that they say are backing these stable coins are actually as high quality as they say. Now, US regulators found that Tether, which is a very prominent stable coin, had falsely claimed its tokens were backed by US dollars. I think the regulatory attention needs to be in a number of areas. I put them on the right-hand side. And they're going to come up again when I talk about decentralized finance or DeFi. Now, the Financial Policy Committee on which I sit, as well as regulators in the US and Canada, are getting to this. But I think that the work that we need to do is still quite considerable, and we need to get onto it. So I made a claim that Bitcoin, for those who like Bitcoin, they're not going to like my claim that it's not a great store of value because it's really volatile. And so I thought I would just back up my claim by showing you a chart of the value of Bitcoin vis-a-vis the US dollar. That's the blue line. And then the value of the US dollar vis-a-vis the Canadian dollar, which is the line you can hardly see because it's so stable. It's the orange line. And you can see with volatility like this that you're not going to want to go and buy a coffee with this. You're not going to want to store your value there, the money that you've got for your weekly groceries or your monthly rent. This is not the place to do it. Instead, you're more likely to want to hold this if you have a high enough risk tolerance to earn some capital gains over time. And you can see what this chart shows is basically the correlation coefficient. So if it goes up to 1, that means it's positively correlated. If it goes down to -1, it's negatively correlated. You can see that the correlation with the S&P 500, with the NASDAQ, is actually pretty high. It's been as high as 0.8%, the correlation of the Bitcoin price. And so you could see that it moves more like a risky asset than it moves as a safe asset or somewhere to go as a safe haven against inflation. Typically, people would think of different traditional assets to hedge against inflation. Gold is one of them, and here you can see in the purple line that the correlation between the Bitcoin price and gold is actually negative. So if we turn to DeFi, this space is really focused on discussions about crypto assets and Bitcoin in particular, Dogecoin, non-fungible tokens, which I won't have time to get into, but happy to answer questions. And if you're not familiar with it, you got to scratch your head about where does DeFi actually fit in. And I think this diagram works pretty well because it's a stylized way or an intuitive way to see how they fit together. If you look at the top panel, those are the crypto assets that I just talked about. Those that are stable coins supported by backing assets, those that are unbacked. These crypto assets actually enable a whole pile of activity that are very usual financial services in a different way. And so what kind of financial services do they enable? Well, things like lending or payments or investment, even enable insurance. And some of these crypto-based financial services are provided in a centralized manner. And that means that they're through entities that have legal structures and centralized governance. For example, you can invest in Bitcoin using Goldman Sachs or use the services of the CME group to do certain things. They're also increasingly being provided in a decentralized manner. And so they ditched the trusted third party or the traditional financial institution, and instead they use smart contracts based on blockchain to do all the work. And so in my mind, the biggest distinguishing factor from centralized finance and decentralized finance is that these smart contracts and the protocols take the place of intermediaries. And as in the traditional financial system, there's a growing wealth of financial infrastructure that supports it. So you need exchanges, for example, and here you can see Coinbase and Binance are going to be companies you hear about all the time. Now, these entities, like Binance, have centralized governance, so regulation and supervision should, in theory, be straightforward, but compliance is still an issue. There have been cases where some of these entities have been denied an ability to provide services in a particular country, the UK being one of them for Binance, because the entity just didn't want to or was unable to satisfy the requirements or give the right information. With DeFi, on the other hand, there's often no legal entity at all, and so it's harder to figure out how to actually regulate. Now, the total value that's locked in DeFi is gone from pretty much zero in 2017 to about $75 billion today. And And I'm a mentor on the blockchain stream at the Creative Destruction Lab, and I can see the energy and the money that's going into the development, and that's because there's a lot of people who see potential advantages in decentralized finance over centralized ecosystems. And, you know, it's pretty intuitive. If you have decentralization, well, it reduces the reliance on intermediaries and their inefficient infrastructure. You've got smart contracts, which enable an automated execution and creation of new financial instruments. And the DeFi protocols can actually integrate with each other. So the data are easily shared. In traditional systems, these data are siloed, so they don't talk to each other. And I could go on about the potential. Now, of course, I'm more of a brain of a central banker and a financial regulator, and so I see that there are many of the same problems that are raised that we see in the traditional financial system. And the most immediate is related to fraud, misappropriation, conflicts of interest. You think about governance, it's supposed to be decentralized, but in some cases, the operations and activity within DeFi are governed or administered by a very small group of developers and investors. There's also the risk of money laundering, terrorist financing, a new way to avoid sanctions. And investors and users of DeFi are also exposed to important risks just related to the underlying technology. And so we've seen flash loan attacks that take advantage of temporary defects in the price feeds. And they do this to steal funds. So I think that this slide, and I hope when you saw the whole ecosystem, it should make it clear that the issues and the opportunities extend well past the crypto assets themselves, well past Bitcoin, to an entire and quite quickly growing financial system. Now, right now, the risks that I've talked about are not risks that are big enough to pose serious risks to financial stability, but these risks are growing. And the way we think about it is to think about, well, how could it disrupt mainstream payments, or what would be the impact on systemic financial institutions? Like, would they get big hits to their balance sheets in a way that would create the disruption like we saw in 2008 and 2009? How would it impact on financial markets? And I think importantly to people that our neighbors and our families, how would it affect the households who have invested in this? And would it be big enough to create a need to seriously tighten your belts and then have big effects on the economy after that? That's something that regulators and central bank authorities, financial stability authorities are keeping an eye on, and something that I'm working on with the Bank of England. Now, if we think about it, in my view, there is a collective response that's needed, both to make sure that the ecosystem lives up to its promise, which I think it has, and avoids it, all ending in tears. And I think whether or not we get the promise really depends on whether or not we act collectively to support what I would call responsible innovation. And in my mind, there are many things that go into that. I thought I would just highlight 3 pillars of this safe modernization or responsible modernization. And the first is that we actually need to modernize our legal and regulatory frameworks to support this crypto activity and this emerging DeFi system. Businesses need absolutely to have clear and predictable rules of the game, and the risks of the financial system must be managed. And this isn't any different. If you're a business trying to start up and you don't know what the rules are going to be, it's really hard to have confidence in your business case. The second thing is that we need to fix the retail and wholesale payment systems that we already have in the traditional system, including remittances, those who are trying to send their money to their families overseas. It's so expensive. And I think the door is wide open for innovation here and potentially disruption from crypto assets. And third, I think we need to consider central bank digital currency, or CBDC. I already talked a lot about the first pillar. I thought I'd spend the rest of my time just focusing on the last one very quickly. First, a definition. So what's a central bank digital currency, and what's it got to do with crypto? Well, a central bank digital currency is best thought of as a digital form of cash that's a liability of the central bank and regular citizens, that they can use it to make transactions. So there's already over 50 central banks that are working on this, including the Bank of Canada and the Bank of England. Now, no decision has been made on whether or not to issue one. I think it's fair to say that the crypto evolution has motivated central bankers to accelerate this work. And I think it's because there's a growing recognition of the potential of a central bank digital currency to safely support modernization of payments and the monetary system. If you just look at this chart that the Bank of England put together on the positive use case for a central bank digital currency, you could see that it could be a building block for better domestic and cross-border payments. It could avoid some of the risks with new forms of money creation, like the risks I talked about with crypto, and it could retain access to central bank money in a world where the use of cash is declining. Now, to be a bit provocative, you might wonder why we would care if cash declines when everything's digital anyway. And I think it's important to understand the reason we would care. Now, we could still do monetary policy if we just had private money, we didn't have cash, which is a form of central bank money. We could provide lender last resort services. And you could say maybe the private sector is more innovative anyway, and so we shouldn't care that much. There's a big that may be reasonable, but there's a big but here in my mind, something that should give us serious pause, and that is that regular citizens would lose access to central bank money, and that matters because commercial bank deposits, our banks are very safe. What we think about around the world, they're subject to default risks, and we've seen that in history in other countries. People actually, when you survey them, I have one from the Riksbank here, but they actually care. They want cash or they want central bank money because they don't want to be forced to go through private banks. They might choose to do so, but they want to have an option. And I think that we tend not to worry too much about whether we have access to central bank money. That's because we still do. But if cash were to disappear, then we would lose access to the safest medium of exchange that we have that supports confidence in the financial system. Now, of course, central banks have to deal with some pretty important policy issues before actually deciding that that's what they want to do. And I think the first issue is really how would a central bank digital currency interact with private bank deposits, your commercial bank deposits. They could be, especially if a central bank digital currency bore interest, it could be in competition, and you'd have to think about how to design the currency so that you wouldn't, the central bank digital currency, so that it wouldn't have that negative impact. I think also you need to worry about people running to central bank digital currency in times of a crisis and creating a destabilizing environment. Again, there's design features that could help mitigate these risks, but they need to be thought through. You have to think about security and integrity. You want to make sure that we've got data privacy, that it follows the data privacy laws of the jurisdiction in which you're issuing this. So for Canada, Bank of Canada is being really clear on that. You have to make sure that it's not subject to fraud or hacks or digital counterfeiting. And you want to make sure that people, if you build it, that people will come. It needs to be convenient. It has to be inexpensive to use, and merchants are going to need to adopt it, and that's partly their choice. So very quickly, I think that a way to make this real, these issues that we need to work through, is just think about what the design features would need to be like. Would this central bank digital currency bear interest like a deposit? Well, as I said before, we'd have to worry about competition with private bank deposits or commercial bank deposits. There'd be tax implications if you earned interest. Think, to what extent is this private or anonymous? We're looking at anti-money laundering or counter-terrorist financing regulation. It would be tricky to make it completely anonymous. But again, there are privacy laws there to deal with the privacy issues. Would this central bank digital currency be available offline or only if you were online? That's pretty important if you're worried about financial inclusion, people in regions where their Wi-Fi isn't reliable, or operational contingencies for power outages or other things. So it's a lot to decide, but I think that this area of work and research for central banks is pretty exciting, and the whole area of modernization of our financial system is something to be invested in. My final points are really just summarizing the messages that I hope I gave, which is we've got crypto assets, which are the bedrock of a new financial ecosystem. And because of that, my first order of business that I would promote for regulators to think about and to get on is consumer protection and market integrity. And that market integrity includes anti-money laundering and counter-terrorist financing and all that stuff that makes you have trust in the financial system. Now, the opportunities and the risks that are out there with crypto extend way past the crypto assets themselves to all the financial services that they enable, and in particular those in decentralized finance. Now, risk to financial stability may be small now, but they're definitely rising. And I think the third point is that these risks don't have to end badly. Authorities, if they're proactive in building the right regulatory and legal infrastructure, will be able to guard against the further buildup of risks and support responsible innovation. I can't emphasize enough just how history repeatedly shows us that a set of financial activities or services that grow rapidly, that achieve a certain scale, end badly. They end in tears, and the people that suffer the most are those that can least afford it. So I'm ready for questions.
Thank you very much, Carolyn, for a very thoughtful lecture. And within such a short time, you covered lots of grounds, pretty much give us a very big picture type of thing. Now we're going to start with the Q&A portion for this event. The number of questions, both from the Q&A and the chat. So I'm going to relay the questions to Carolyn according to the time that the question is posted either in the chat and the QA. Meanwhile, people in the audience, if you have a question but not typed yet, please type your question in the Q&A. So I will also read that to Carolyn too. So let me start with the first question. The first question is actually from chat. Let me go to my chat. So Doug Lonsberry asked, how is it mined? Why does it use energy? I believe Doug refers to Bitcoin mining.
Why does it use energy?
Yeah.
Yes. So you need the miners to you need the miners to validate transactions and also to mint new coins or new crypto assets. That's how the system works. And what you need to do is find a problem or make it costly for them to do this and make it hard to cheat. And one way to do that is to have this really hard mathematical problem that's actually arbitrary, but it takes a lot of computer power and therefore a lot of energy to solve the problem. And so that creates security on the one hand in the Bitcoin system. You can have a lot of confidence that what's on the ledger is right and it's immutable. But the problem is that when you add it all up, the energy usage is enormous. And so this consensus mechanism may be secure, but it's really costly from an energy point of view. There are other consensus mechanisms like proof of stake, where that uses less energy that are being developed. And in fact, Ether has planned to convert to this this year. But again, those consensus mechanisms also have their downsides. It may not be climate related downsides, but it's got others primarily related to fairness and security. So it's still something that technically is being worked out.
Okay, thanks, Carolyn. So the next question is from Dustin Young. So the question is it possible that Bitcoin could become more stable as it becomes backed by more people, countries? I understand the volatility is a risk. It now holds to be more widespreadly used.
Yeah, there's some people that believe that, and I think part of it is they think that the underlying mechanism has a fixed supply, and it's sort of evenly supplied over time, or it's supplied in a steady way over time, should help stabilize it once there's enough people using it. I think the other factor that people put in place is if there are ways to hedge your foreign currency risk, because that's what it is, then that will also complete markets in a way that allows for stability the same way you would have in a fiat currency, like the Canadian dollar. Why I think that's unlikely is that demand for any particular currency is always going to fluctuate a lot. And in fact, any mechanism that's based solely on supply, money supply growth, is kind of doomed to fail when it comes to stabilizing prices in the value. We saw that in the 70s when traditional central banks tried to use money growth rules. I tried to estimate them to make them work. In my career, I think everybody has to do that when they join the central bank. Couldn't find anything. And so I just think for that and other technical reasons that it's unlikely to happen. And what's more likely is that some other type of coin that serves a real purpose in a financial system and isn't just there for speculation will gain prominence.
Okay. Thanks, Carolyn. So the next question, there are two questions in a row from Don Tapscott in the chat. So let me read both of them. You can choose which one is your answer or which one goes first. So the question is as follows. Should Canada have a CBDC? Alternatively, should the Canadian banks and others get together and create a stable coin pegged to the Canadian dollar? That's question one. The second question is, Canadian banks seems slow adopting DeFi, the crypto and the blockchain technology. What's your view?
I see. So hi, Don. I know Don. So hello. Yeah. So, well, I said that should Canada have a central bank digital currency? I was very strong from I guess, instigator for the work that the Bank of Canada is doing on central bank digital currency and crypto more generally when I was senior deputy governor, because I thought that it was a real question that we needed to answer and that we needed to be ready to issue one if the answer was yes, because meanwhile, the private sector is moving on. And this was a build, if we wanted to do it, that would take a number of years. That being said, I think it's sensible that no definitive answer has been given right now for the reasons that I said in my talk about the technical issues and the policy issues that we still need to think through. And clearly, if a central bank were going to do it, especially in Canada, they need the support of government. It's not something that the central bank could just do on its own. So you need to build the consensus about the need to do it and the design. The most important part to me, though, is if you don't have a safe medium and exchange, you don't have a solid foundation for your financial system. And so wherever we end up, that is table stakes.
Okay. The other part of the question is, should the Canadian banks get together, develop a stable coin that is pegged to the Canadian dollar?
I'm not going to give the Canadian banks advice on what they should do for a commercial product. So I would say, though, that there are already stable coins out there. The US dollar coin, it's a highly competitive space right now, and so they would have to factor that, what the angle would be for them, because that's a space that's being filled. It has been filled by some and being filled even more now. The US dollar is going to be the first place to start for a stable coin, given US dollar's prominence in the global financial system as a reserve currency. And so you can understand why that's already a crowded space.
Okay, thank you. So the next question comes from Vidal Guerrero. Sorry if I pronounce your name wrong. I'm not sure the question. I'm not sure I understand the question, but let me read anyway. So, do you think much of the discussion of central banks developing digital currencies is only more bullish for decentralized crypto assets?
I'm reading it here. I think maybe what's meant there is that it creates a little bit of a competitive race, and so to the extent that decentralized crypto assets and currencies and that decentralized finance is serving in part a subset of society that doesn't want to be in the traditional financial system. Any development in the traditional financial system is only going to, edge them on to compete with that. I don't know. I think that the decentralized crypto assets that are providing a service, that are safeguarded and create efficiencies for households and businesses, can easily, that are based on solid business models, can easily coexist with the central bank digital currency. And in fact, you could imagine a central bank digital currency creating a foundation for that world. There's a paper by Carolyn, who was part of the Diem project, which is, you recall, was Facebook's project to create a stable coin. He wrote a paper that argued just that they could not only could they coexist, but the central bank digital currency could be foundational. And so there's not a single answer to that question, but I think the prominent one is that they can coexist.
Okay. So the next one is from my colleague Zafar. Hi, Zafar. So I'm going to read your question to Carolyn. So Zafar Kayani from Economics Department. So historical evidence reflects that regulators wait too long until newly invented financial products spread widely in the global financial markets and confuse stable financial system, whether unregulated product like Bitcoin will be significant alternative financial assets. Should not world regulator leaders act timely before it significantly affect the global financial markets? Is it not the adverse selection behavior of regulators?
So the only answer to that question is yes. Of course, the regulators should try to be proactive. That's the word I used in my conclusions instead of reactive, and they should be timely before it's too late. We saw that in the global financial crisis with respect to household finance and mortgages and all the products that were surrounding that in the US and how it's spilled over to other countries. It's easier said than done. And so it's not a defense of regulators, it's really just the reality that regulators, number one, actually do care about innovation, and it's not their mandate to step on things when they're growing. Like stepping on newly planted grass is when it's just coming up is maybe not a great idea if it's not a real risk to the financial system at large, and individuals are saying that they are willing to take these risks. On the other hand, it can move really fast, and it's moving really fast. And so by the time you kind of get to it, it may be that the risks have already built up. I think the other point is that it's a completely new area. And so, my plea to governments and those who are in charge of financing for regulators is that they need to have the staff with the right technical knowledge and skills to be able to do this correctly. You couldn't imagine a banking regulator coming up with rules that didn't know a thing about banking. It's just a fundamental requirement. And so I know that regulators around the world are doing just that, but they need support to be able to get the right skills and the right technology. And they also need to change or augment how they do their work by consulting with players in the industry that they may not know very well already, like they know the bankers. And so I think this crypto is a bit like the new shadow banking, in the sense that it's coming in through the unregulated space, and my plea is for regulators and lawmakers to be very proactive in dealing with it, and not just because I don't want to shut it down. I just think if we're a business, I see this in CDL, in the Creative Destruction Lab, for a business to thrive, they need to know the rules of the game. It's not easy when those rules change over time.
Okay. So what is that for? That's good. So the next question comes from in chat, is from Down Tap Scott again. So China seems to be leading the CBDC chase with its DCEP. Does this threaten the US dollar as the currency of record globally?
Well, clearly China is out the gate with its central bank digital currency, and they've been working on that for a very long time, and they have their own policy goals with respect to creating a digital currency. And so within the country, it has implications for uses of other types of means of payment, and also is probably the reason around why the Chinese government is not so keen on Bitcoin and other cryptocurrencies. In fact, has disallowed their use in one way or another. If you leap from that to will it replace the US dollar in the global monetary system, I think there are other building blocks that China would need to do that. One of them is a complete financial set of markets that allow for hedging and managing risks associated with being having a floating exchange rate, which they don't have right now. And they'd have to have, along with that, fewer capital controls, if not no capital controls, and predictability around that. So the certainty that politics or parochial economic interests wouldn't change those capital controls over time. And until that happens, I can't see the Chinese the renminbi becoming a major reserve currency. Things do change. It wasn't always the US dollar, it was the sterling before, so never say never. I just think those building blocks need to be in place. It's not just about the technical CBDC.
The next question is from colleague Zafar again. So if Bitcoin is recognized as money, i.e., for example, or generally acceptable as mode of debt payment and X as medium exchange, then the conventional definition of money supply may need to be redefined, and of course, the monetary policy instruments.
Well, if it were, and it has been in some jurisdictions, I mean, must say that those are jurisdictions that don't have a stable national currency themselves, and they don't have a credible central bank or central bank-like policies. So if Bitcoin were to be accepted or actually used widely, then you would have to think through your measure of the money supply for sure. I don't see in countries that have I guess reliable central banks with the track record, Bitcoin becoming big in the sense of a store of value, a unit of account, and in the other components of money. So theoretically, yes. In practice, I don't see that happening in a country that's advanced like Canada or the US. But never say never. And I think, just to be clear, there's a difference between Bitcoin being purchased for investment, for speculative investment purposes, and Bitcoin being used either through law or through practice as a means of payment, the same way the Canadian dollar is, or your Interac card is. That Interac deposits that back up your Interac account are part of money. I don't see that happening with Bitcoin.
Okay, thanks, Carolyn. So the next question comes from a chat from Vido Guerrero. Carolyn, can you see the chat, or should I read the question?
I'm looking at the chat, but is it at the bottom?
It's at 7:40 p.m. Maybe I should just read it. And how much of the current market activity and investment in crypto assets is purely speculation and a greater full approach to investment versus those that in decentralized assets, or hope that one day it will be seen of value, and so are riding out long-term despite volatility?
So if you take, it's a hard question to answer, but if you take investments in crypto, unbacked crypto assets like Bitcoin, and you do surveys, it's clear from the surveys that people are doing this for investment purposes. Some are just curious, but it's mostly, some use it for payments, but mostly it's investment. It's a value judgment whether or not it's a fool's approach to investment or not. I happen to think that Bitcoin has no intrinsic value and only has grown in value because people believe it will grow in value, which doesn't feel, and more people are buying it, which doesn't feel like, doesn't coincide with my risk appetite. Now, the investment in DeFi, which is different. So crypto-enabled financial services. I think right now those financial services are really mostly serving the people who are long crypto. So gives them something to do with it. But the purpose is a bit like, feels more like the beginning of the internet, where that's what it's doing now is people try to figure it out, but they really believe it's leading somewhere. And it leads some people to talk about Web3 and all kinds of a really different universe for financial services in the future. So some of these investments in DeFi are really a longer term view of where this is heading, and what services it can bring back to citizens.
Okay, so the next one comes from chat is Don Tapscott again. Hi Don. No, I already know you. So the question is, what do you think about Mark Carney's idea about a global synthetic hegemonic digital currency that would be a roll-up of national CBDCs?
Yeah, that idea was came in this speech that he gave, and I believe that it was Jackson Hole, which is like the conference with a capital T for central bankers of the year, and that the U.S. puts on. You know, and what he argued was that instead of having the U.S. dollar as the reserve currency, we could, you know, have a kind of a stable or a synthetic digital currency that was basically a weighted average of a number of different currencies, and that could create better dynamics in the monetary system for countries. And it would also, because it was digital, enable cross-border transactions and other things. You know, as usual, that idea has some theoretical merit. In theory, you can see why that might be a good idea. I guess when I look at how it would work in practice, that it would be very difficult to get countries to agree to be on that and agree with the weight that their currency would have. It would be technically very hard to achieve a currency like that, and it would need a track record to be adopted. And so I'm not sure about just how tractable that idea is, but certainly Facebook thought part of it was tractable because their very first offering that they were trying to get going was called Libra, and it looked a lot like Mark Carney's idea. And so the issue that came up, because it was private, was if Libra, which is this basket of currencies, was going to be a basket of currencies, was widely adopted and people started using it, individual countries would lose control of their domestic monetary policy, and there was no central bank governor or finance minister that would agree to that. And so these kinds of digital payments means can have broader implications than just efficiency. They can actually interact with your domestic monetary policy in a way that's not advantageous.
Okay, thank you, Carolyn. We still have maybe 2 minutes. Maybe I'll pick the last question. Then from chat, Alan and Bronger, sorry if I pronounce the name wrong. So how useful is the ecosystem metaphor? What represents the food chain? What is the top predator?
That's a very profound question. Yeah, I think part of it is that the reason I think the metaphor works is that there's a series of connections and interdependencies that occur between the participants and the providers of services and the services themselves within the ecosystem. In the traditional financial ecosystem, in fact, there is a sense of, I wouldn't call it the food chain or the top predator, but but I would call it, there's a tiering where you do have the central bank at the center, and because of the way it's structured, usually the other ring is usually the biggest banks, and then you kind of keep going out. So in the DeFi system, it's hard to know where this ecosystem will settle, but certainly there are the basic elements of interconnections between the providers of services and the clients, the services themselves, and because of that, the financial efficiencies and financial risks kind of operate through these channels, and it's really important to understand that.
Okay, we still have one more minute. I'm not sure you're willing to take one more question, maybe a quick question, right?
Yeah,
This is from I think it's let me see. Just give me a second. This is from the chat, from the Q&A. So, how does cryptocurrency have a significant carbon impact? Very briefly.
Oh, so that's a great question. And it's back to what we were talking about with the consensus mechanism. The environmental impact just comes from the computer power that's required to run the system. It's enormous in systems that rely on proof of work, and the biggest crypto asset out there right now is Bitcoin. It relies on that. And so where there are big mining communities, they tend to focus in areas where energy is abundantly available and inexpensive, and it creates a major draw on energy consumption where they're located.
Okay, thank you, Carolyn, for taking the time for the questions. It's really great. You have answered all the questions. Really thank you for that. Unfortunately, that's the time we have this evening for Q&A. I thank you again. I appreciate all the questions. Unfortunately, there are many more questions we don't have time to answer. Now I'm gonna turn the floor, I guess, back to Byron Liu to make closing remarks.
Thanks, Yutal. Thanks for moderating tonight's Q&A. We did have a lot of questions, and they'll just have to go unanswered. Thanks for everyone for participating and showing up. That's great. Wish I could see everyone, but I know there's a lot out there. A sincere thank you to you, Carolyn, for sharing your time with us this evening. Not only was your talk highly informative, but I am reassured knowing that thoughtful people like you are considering the implications of and developing policy to address crypto. I'd like to thank Professor Kitchen and colleagues and friends and donors for their contributions to make evenings like this, and this evening in particular, possible. And thanks again to everyone, and I hope you enjoy the rest of your evening. Good night.